Okay, so we're going to continue in our series of options myths. Today's options myth number 7. We've been talking about the various myths that surround options, market neutral, positive theta, trading, and the pitfalls of falling into the traps of those myths. So options myth number 7 is, I just back tested a strategy that will give me a 50% return a year. This is fantastic. I'll just mortgage my house and double my money in a year. I'm rich. Not so fast. And why you can't think like that needs to be broken down. Most back-tested activities or back-testing activities take place through people back-testing through their brokers, software, or more likely back-testing through some commercial software analysis software which has data from previous years. And people like to do back tests based on the premise that you can get mid prices in the market most or all of the time, and therefore you could just go ahead and back test your strategy, assume you'll be getting mid prices, and see what happens. Of course, when you're back testing, there's no money up, there's no money involved at all, and you're very calm. You're probably drinking a cup of coffee, listening to some nice music, and you're back testing, and everything's copacetic. There's no real money on the table. Also, when you back test, it implicitly assumes that you're going to be completely aware of when you've hit an entry point, an exit point, an adjustment point on your trade, and you have perfect omniscient knowledge of exactly what's going on in the market, and you will always respond in a very, very efficient way to that. These are all the basic assumptions of backtesting, but unfortunately most of that is not particularly real, and so we've got to drill down to understand why these things are not necessarily particularly real and get more realistic about the outcomes of our trading. The reality is almost no one trades like they backtest. It's an unbelievable fact if you have a successful backtest, but it is a fact. Now, there are two reasons, broad reasons, why you don't trade like you backtest. The first one is that you can't. That for technical market reasons or for technical trading reasons, you can't actually trade like the backtest would suggest, and we'll get into that in a minute. The second major reason, probably the more important reason, is you won't trade like you backtest, meaning for emotional reasons you don't follow your plan. So let's take a look first at the technical reasons. What are the technical reasons you tend not to trade like your backtest? Because you can't. The first thing is you're not going to get filled at mid prices most of the time. Why? Market makers have to make a profit. Mid prices are not particularly profitable for them. They make money when you're overpaying, basically, or being underpaid for something that you are selling. And sometimes, for various reasons, they want a lot of profit. And we've actually seen this the last couple of weeks. Fills are tougher, and there's numerous examples of people getting filled at way over mid prices. So the assumption that you can get mid prices in reality is questionable at a minimum. And the other thing is when the market is moving very quickly, you can forget mid prices. The market makers know that they can get more from you because you're normally desperate in a fast-moving market situation, and you've got to control your deltas, you've got to control your vega, whatever. And so they are going to make you pay dearly for the protection you are looking for. And so they're profiteering a little bit, and they're also protecting themselves. So for various reasons, you're not going to get filled at mid when the market's moving. You're not going to be sitting there, demanding mid, because they'll be just laughing at you. So that's another reason that mid is unrealistic. And finally, there's a very funny situation that happens where you think you can close a trade because your software tells you the price you could close the trade at, but in reality, one of the options doesn't even have an offer. This will often happen at the end of an expiration period where there's a very way out of the money option. And if you want to buy it, the market makers are happy to sell it to you for some ridiculous price. But if you want to sell your option, they're not literally going to even offer you anything for that. They think it's that worthless. And so you really can't get out of long positions that are way out of the money, even though the software just averages zero with whatever the ask price is. It gives you some number, but the number doesn't mean anything. So that's another reason the software will tell you you can get filled, because it always gives you some price, but in certain cases, there is not a price. You cannot sell a put way, 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 way out of the money 1 hour before expiration. Nobody's going to buy it, therefore you can't sell it, therefore there's no price for it, therefore you can get no value from it. So those are the reasons you can't get filled at mid, but there's other technical reasons too. One of them is, in a back test, you never make an execution error, do you? Because you're not even in your broker. You're not trading live with your broker. How can you make an execution error? It's not logical. So you make 0 execution errors. Well, I'd like an email from somebody who's never had an execution error in their trading career. I'd like to meet you, give you an award. So the back test takes no consideration of execution errors. Another thing is, you might just make a flat out mistake. You were supposed to roll your credit spread when your short strike got to 18 delta, but you just got mixed up and you did it when it was at 28 delta, okay? You didn't make an execution error, you just didn't follow your strategy because you were sloppy. Back tests do not take that into consideration at all. And I'm sure many of you have done this. I'm sure all of you have done this, in fact. Another reason, technical reason, you can't trade like your back test is because your trade that you're adjusting, let's say, is probably not the only trade you have on. If the market's moving quickly and you've got to be triaging between your trades, you've got to be deciding which trade I'm going to pay attention to first. Well, that may not be the trade that you're back testing. And so therefore you will get to that late, you will be in a worse position on that trade, and therefore you won't be trading like your back test. And finally, and there's a subtle reason, but if you've traded for a while, I think you'll relate to this immediately. If you have a back test, and the back test assumes you had a certain entry price, and which you didn't because you had to pay more than that, and then the back test hits target, but your actual trade does not hit target because you didn't get it at the price that the back test would have suggested you would have gotten in. You got filled worse than that. Then one day you may hit target in the back test, not hit it in real life, and then the market suddenly changes and all the profits that you had, the profits that were close to target, are now washed away, and it can actually turn into a loss. So a positive month in a back test actually can become a negative month in reality. So for all those reasons, the back tests are not reflecting the way you actually can trade. Even if you were the most diligent guy in the world, had complete control over your emotions, some cases you just can't trade like your back test would suggest you could. But, and in my view, more importantly, are the emotional reasons that you don't trade like your back test. And the first one is, it's a poorly designed trade. And even though it gave you a 50% return, it put you into incredibly scary circumstances. You go in overnight and you're positive deltas, and some big event is happening the next morning, an election or Brexit or something. And if you're wrong and the market doesn't bounce, you could be in really big trouble on that trade. So you get scared, you get out of the trade because your deltas were really too positive overnight because the trade is designed in too risky of a manner. So you just close the trade out of fear, when in fact it could have worked out just fine had you stayed in, and in fact in the back test you would have stayed in, because you're just backtesting the strategy. There's no money up, so you might as well take a look at what would happen. Well, the reality is if the trade is designed poorly, you're not going to trade that way. You're going to pull the trade off and then possibly avoid what could have been a large gain because the bad thing didn't happen. A second closely aligned reason you emotionally won't trade the way you're supposed to trade, according to your backtest, is that you're watching too much TV. You're reading too much and you're getting freaked out by the news and the talking heads, and you pull the trade off completely before whatever fear you have suddenly comes into play. And so in your backtest, though, you're not sitting there reading the Wall Street Journal every day and trying to make decisions based on that. You're just looking at the price action, volatility action, and following the trade plan. A third reason, emotionally, you might not trade the way you did in the backtest is you may be having a bad month with your other trades, but a good month with the trade you've backtested. So you decide, hey, I just don't want to have a bad month, so I'm going to close the trade now. That'll cover all the losses in all my other trades. I'll have a positive month, and I can give myself an attaboy, all right? Well, that's not trading like your backtest. That's trading your P&L, and that's trading to make yourself feel better as opposed to sticking to your plan. And finally, another emotional reason that you won't trade like your backtest is because you're trading much larger than your backtest. You traded a $10,000 account in your backtest, you got cocky, now you're trading a $300,000 account, and all of a sudden what was a small drawdown in the backtest is a very large drawdown in cash, and therefore you get upset, you get freaked out, you lose your perspective, and you close the trade. So there's a mix of technical and emotional reasons why people don't backtest and trade the same way. And unfortunately, almost all those reasons are the wrong reasons in reality. And so what's the conclusion? The conclusion is backtesting does not really reflect the reality of trading. I'm not saying backtesting isn't helpful. In fact, I think it's absolutely necessary to weed out poor strategies and to focus on strategies that actually have potential to work. But to assume the return you get in your backtest is what you will get in reality is a weak assumption. It's just not realistic. So one rule of thumb I like to tell people is whatever you got in your backtest, cut it in half as a return. If you got 50%, think of it more like a 25% strategy. Obviously, this is not scientific, but the intent behind that rule of thumb is realize that you're going to have to dramatically cut your expectations because you're human and because you're in a real market where real things happen that you can't completely control. So don't go out, mortgage your house, try to double your money. That would be a very foolish and dangerous thing to do right after you get all excited about a backtest. Take a strategy and trade it for a while. See the realities of the execution. See the reality of how it interacts with the other strategies in your portfolio of trades before you get ahead of yourself and save yourself a lot of money in the process. Backtesting's necessary, but it's not sufficient. You've got to trade. You've got to trade live, see the realities, and then take it from there. Thanks very much, and we'll see you next week for Options Myth number 8.